So I'm Sankalp from PMSCIF World, and we are one of India's leading digital wealth manager. We specialize in portfolio management service and alternate investment funds. And as you know, we've been doing this Invest Sense webinar series with top fund managers and trying to probably put some direction and understanding on where the market is headed and what's happening and where investors should look at or where investors should be aware of. So today's topic is very interesting. It's we're looking at lifetime highs in the markets, although there is some points of the lifetime highs, but it's an overall interesting times. A lot of concerns, a lot of questions, and aptly we have titled this episode as current market shifts and the changing portfolio dynamics. So we have seen that certain kind of stocks that have done well, certain kind of stocks that languished, certain kind of stocks that did came out of their long pending time corrections and have been doing well, and few stocks that have done really well have been underowned for such a long time that nobody really benefited out of it, or very few people did. So all of those we're going to take up in today's session, and we have Mitul Patel, the fund manager at equities at IIFL Wealth and Asset Management. We have Shashi, who is a senior partner with IIFL Wealth. And before I hand over to you guys, Mitul and Shashi, let me just give you the statistics for a poll I ran. So I asked, I am unsure where the stock market is headed now. 75% of the respondents said yes. We've got a task at hand. We got some knowledge to probably share or some insights to share. So over to you guys, and let's begin.
Thank you, Sankalpo, and good evening, everyone. As we start the day today, and as Sankalpo set the floor right, what we'll try to do today, we've seen now this pandemic with us coexisting for last 1.5 years plus. So it's not a new phenomena. Looks like has become a part of life. Markets have been doing well over the...
Actually, we can only see your eyes. If you can just hold the device a little bit lower. Yeah, perfect.
Yeah. So markets have done quite well through this pandemic. But some stocks which used to do well have not done well, and other stocks have done well. What we're trying to say is that while prices will look better, perform, whether the investors have been able to get those returns, their portfolios, and what are the changes that the portfolio managers are doing to their portfolios today to get the right stocks which are moving, and why are these changes required? So today we have Mitul, who will talk to us as to in the pandemic, everyone knew that the financials will slow down because the biggest stress comes on financials. But which are the other sectors of the stocks which will benefit from this and do well? And accordingly, has one been able to doing well and remain away from stocks? Is this very temporary phenomena? Does this cause an unnecessary churn to the portfolio, or is it a necessary requirement? So we'll answer all these questions and how portfolio managers, and specifically at IIFL, how are we making so that the investors benefit from all the kinds of ups and downs. Over to you, Mitul.
Thank you, Shashi. And I hope everyone is safe because of COVID as well, and because of the cyclone that we have currently going on. So I hope everyone is safe and healthy at home. I would like to start off the presentation and welcome you all. Sankalpo, you can put up the presentation.
Sure. So while I put on the presentation, let me just put a disclaimer to all our participants. We might discuss stocks here. They're not to be construed as advice or suggestions. They are on a more insight and academic purpose. So with that tone, over to you, Mitul. And if to the audience, if you guys have questions regarding the presentation, do keep sending us. We'll take Q&A at the end of the presentation. Thank you. Over to you, Mitul.
Thank you. So guys, thank you for joining. Obviously we are at this very interesting juncture in the markets. Things were looking up pretty well, maybe 60 days back. We just went out of the budget. which was not material in a way, but in terms of any major announcements. And the market was, also rallying pretty well. And we had a bit of a speed breaker, of sorts, unfortunately, because of the COVID crisis, which hit us very badly during the second wave. And that kind of, let the steam off a little bit of the markets. But, the most important thing is, what has happened, why are markets so buoyant right now? What are people expecting? Markets are always forward looking, and what happens over the next one quarter is extremely irrelevant in the larger scheme of things and in the longer scheme of things. And we want to look forward, and see as to what are markets trying to price in. And we also, during this presentation, we'll look at how, over the last 5 months and over the last 12 months, how has market behaved? We have all seen this meteoric rise of the market over the last 12 to 15 odd months, right from the lows of March 2020. And, we are, always, generally people are very surprised as to, why this took place. And, a lot of stocks have gone up substantially, but there are very particular set of stocks, that have done much better than the others. And we'll take a look at those as well, and how we see things going forward. So firstly, as we kind of go back, rewind a little bit to March 2020, it was, an extreme sense of risk aversion, a lot of talks about, going into cash, and, because the future was extremely unknown. We didn't know that the companies that are listed in this country are going to be around, if they are going to be around, in what fashion they are going to be around. Will they have broken balance sheets? What is the kind of risk that was going to play out? Nobody knew. So people just sold, incessantly, and, and then thought about things later. So, a lot of large banks such as HDFC Bank, Kotak Bank, everybody thought that these banks are going to get bankrupt. Banks will shut down. A lot of things were taking place, and obviously that didn't happen. Because that time it was a moment of survival. I'm sure if I take a poll right now, Sankalpo, I'm sure that obviously things are much worse in India during this COVID crisis, the second COVID wave. But if we actually take a step back and think about how scared were we, compared to how scared are we currently right now because of COVID, and how scared were we in March and April last year. I'm sure, a lot of people perhaps would say that, there was
right. Let's run this poll.
Yeah.
See what answers. What kind of
Let's
answers?
see.
Okay.
Yeah, I think the answers are pouring in right now.
Yeah.
Yeah, it's settling at roughly 75-80% are currently less scared, than they were, in March, April 2020. So 72% is the less scared number. And, that is exactly, we did not know how things were going to pan out, whether we are going to live, how many of us are going to die. How are things going to, is there going to be a vaccination? There's never been a HIV vaccine. How can there be a vaccine in 12 months time? There were a lot of things that we didn't know. And a lot of people sold everything and sat on cash, and really there was a fire sale, of stocks. Obviously all this is in benefit of high stride, including us. We were also quite worried. But, a lot of things have changed, and we have seen how economies are adapting. How is India adapted? We can talk about everything else, but we are more concerned about India. when we had the longest and the most stringent lockdown, how things kind of came back. Before this second wave, we were talking to companies, and all the numbers that are coming out of the Q4 quarter, most of the businesses, and this is across sectors, apart from a few services sector, most of these businesses had come back to pre-COVID levels or had surpassed pre-COVID levels. So the demand came back strongly. The stimulus in India was nothing much to speak of. Thankfully, we had an excellent rural season, an agri season, which kept the rural cash flows buoyant. And the fear of job losses, salary cuts, etc., was was much more overblown than actually what happened, and things came back pretty fast. The pent-up demand and the continuance of that demand post that was really, really strong as well. And so coming back to what I'm saying is that going forward, what we are seeing is, there are multiple factors at play. Over the next 2 years, there are a lot of talks on social media, in the newspapers, on CNBC. The last 7 years, the Nifty EPS has been flat, which is a fact. But what are we expecting? Market is forward looking. Market is not backward looking. What are we expecting? What are people expecting that? And why is the market at 14,800, 14,700? There is an expectation of roughly 40 to 50% earnings growth over the next 2 years, FY21 to FY23. And that is going to be led by a significant amount of earnings growth coming from the cyclical sector. And when I say cyclicals, it's going to be autos, it's going to be majorly driven by financials, it's going to be the metal stocks, which have a small portion of the weight in the index right now. But in terms of absolute size, these are really, really large companies. And those earnings growth are going to come back. There are other certain sectors which are on the discretionary side of things, which will come back much faster. IT and pharma are really are sort of defensive companies which have not been hurt because of this pandemic. Their secular growth will continue for the next 2 years. IT as well, strong demand going through. So, there's an extremely strong consensus right now that 40 to 50% of earnings growth is going to come in over the next 2 years. That, along with when you overlay the low interest rate scenario that we are in right now, the expected ROE expansion that will happen in the country because of this earnings growth and the low interest rates, things are going to, the market is roughly at 16, 17 times, FY23 earnings. It is at roughly, on a trailing book wise, it is at 3.4 times price to book on a BSE 200. And that leaves a decent amount of room for the markets to kind of do what they, plan to do. So it's a one standard deviation above on price to earnings. When you look at it as well, there could be certain small earnings cuts because of the sort of lockdowns that we have had. But the general trajectory of the earnings that we are seeing are going to be significant. There has been a significant amount of, restructuring, structural changes that companies have made because of this pandemic. Lot of cost structures have been realigned. A lot of savings on SG&A, which have boosted margins, which have boosted ROEs and cash flows. So, a lot of things have happened, never let a crisis go to waste, and a lot of the top companies, good quality management companies, are looking at things in terms of actually running a business in a different way, in a more cost efficient manner. And those things are going to be are getting priced in, productivity will increase, etc. So, there are earnings growth expectations, and that's why market is where it is. And that's why there has been a speed breaker right now. But if there was no second wave in this country, and the kind of recovery that we were seeing, things would have been much, much better than where it is. It's been a speed breaker. We have held back a little bit because of this crisis. But, we have a playbook now. We know what to expect when the economy opens up again, what companies will report, how they will report. And, we know how things will play out, once things open up across sectors. So that's why there is bit more of confidence, within investors and fund managers in terms of how things will plan out. This is just a sort of a chart for you guys is, when you look at calendar 2021 YTD, India Nifty has given 5 percentage points return. But if you look at on the left hand side of the top graph, there are other economies, which have done much better. And when you just kind of glance through it, very, very, from a very top down view, these are the countries that actually, are in a decent stage of vaccination, in a very close way, or the significant lockdowns have been opened up, and there has been a movement in the economy as well. But if you look at on a 1 year basis, India has actually done pretty well. It's actually done better than the S&P 500, and that is because of the fact that though we never had a stimulus, we have not had any sort of a QE per se. Our balance sheets have not been that bad. We have a good amount of foreign exchange reserves, and the kind of performance that India had shown post the lockdown, over the second half of the last 3 quarters of this financial year, things were pretty solid as well in terms of performance. And that's why you see that over 1 year we are up 61%. But if you look at S&P 500, it's 46%. And that's just a broader base of the the US economy, not just the Nasdaq as well. So yeah, in India has done significantly better than other emerging markets going forward. Now, so this is one of the most interesting charts, and this is also the topic of this this webinar as well. When you look at what has happened, this calendar year 2021 YTD, it has been a broad-based market, and we a lot of investors, a lot of people have woken up, perhaps post October, November, once they saw things are getting better, and started investing their cash, etc. It's been a very broad-based rally. And when I say broad-based, is that look at the performance over the last 5 months of the small cap index. Small cap index in 5 months is up 24%, mid cap is up 17%, and Nifty has done only 5 percentage points. And at the same time, when you look at the 1 year, the last 1 year, May to May, small caps are up 123%, mid caps are up 88%, and Nifty is up 61%, as we saw. These are, this is the sort of broad nature of the rally, the sort of recovery that we are seeing. But then when you look at on the right-hand side of this red dotted line, there is one clear message that this graph or this table is giving us, right? It is that, the traditional sectors, the really high quality, high PE, really good high cash flow companies, those companies have actually generally underperformed over the last 1 year. They did quite well relatively for the first 2-3 months from March 23rd to May a little bit, but since May the performance has not been great. Healthcare is the only sector which has done actually quite well, which is in the defensive sort of / secular range, which has done quite well. But if you see this, the graph, the bars that are colored orange, and there are a few which I forgot to color, is that the most of the rally that you see in the markets has been driven by these sectors. When I mean by these sectors, is the private banks, autos, real estate, PSU banks, and metals. And these are part of the cyclical recovery that that the market is seeing right now, and that's when substantial earnings growth over the next 2-3 years is what is being expected out of these companies, which they've started to show as well. Some of them are commodity driven, some of them are cyclical in terms of how the GDP is going to move from here, from this FY21 base, and that's what that's what's important, is that all the secular names, etc., have underperformed. Underperformed the mid cap and the small cap index over a period of time, and the cyclical sectors have done significantly well over this period. And at a granular level, when you break up these sectors into companies, a much more interesting picture kind of comes through. When you look at calendar year 21 YTD, all the stocks that have done well, except for Wipro, which is an IT company, all the stocks are where you see in the orange color are all cyclical stocks. Majority of them driven by metals, but there have been Tata Motors, UPL, which is the global agri stock, as well Adani Ports, Grasim, State Bank of India, Bajaj Finserv. There has been a mix of on financial stock, two financial names. There is one ports name, there is an agro name, there's a global auto name, and Tata Motors is a combo of both, and there are metal names. So there is no HUL, Hindustan Unilever, there is no other stock here on the bottom chart and in the top chart, which gives us a signal that the nature of the market is cyclical, and it will remain cyclical most likely till this earnings growth expectations or the earnings growth once it's delivered tapers off, because these are extremely under-owned names. They have actually destroyed value over a long period of time, and either they are cyclical or they are value traps, and they are very short bursts of cycles that take place, and they generally don't create value over a sustained period of time. But there are certain times that come once in a decade or two when these stocks do really, really well, and then there's some level of cycle that kind of continues, over 12 months, 24 months, where a significant portion of the 10-year returns is made in these in this 1 to 2 years, and that's how the market is behaving right now as well. When you look at the last 1 year and you see the Nifty going up 20%, this is from February 20 to May 21. You look at the Nifty, which is given 20% return, and you look at Nifty excluding BFSI, it is up 32%. BFSI as a sector we are very positive on, but the fact is the major concern, and because of the weight in the index over the last 12 to 15 months, has been the banking sector. In our opinion, this sector has come out with flying colors. If you take the top 5-6 private retail banks, if you include SBI in that list, these banks have come out extremely well in terms of their numbers, what sort of NPAs they are coming out because of the COVID crisis. In this restructuring credit costs range from 1 to 1.5% of the balance sheet, just pure COVID related NPAs or credit costs. That's why, because of the uncertainty, this sector has not done as remarkably well as the other cyclical sectors. And that is one of the other reasons why this sector, in our opinion, should do well over the next 12 to 24 months. Considering its underperformance as well, and considering the fact that these large banks have come out, with flying colors, over the last 3 years in a way, because there have been two shocks that these banks have seen over the last 3 years or 4 years. One is demonetization in December 16, and one is this pandemic. This actually, if these numbers over the next quarter or two come out and they settle there where people are expecting it to settle, the quality of credit underwriting on the retail side, on the corporate side, without any stimulus, etc., speaks, wonders of, what the kind of process that these banks are running, and what sort of retail credit underwriting, is going on in these banks. And these banks should come out stronger with highly capitalized balance sheets and should do well. Nifty ex metals also is much better than Nifty. Obviously, the metal index has done really, really well. But when you look at how Nifty can do, 12 months from now, 24 months from now, if the financial sector does well with its large weightage and the cyclical nature of the market, there is a good probability that we would be much better off 12 months, 24 months down the line than where we are sitting right now. So the case for being extremely bearish, there is an emotional toll that all of us are going through in terms of the second wave, really horrible news, a lot of deaths in the country. But as we move forward, as the situation improves, as vaccination improves, We cannot currently the situation we are in is so grim that we cannot see the light at the end of the tunnel. And if we actually think about it and step back and think logically as to what is market trying to look at over the next 12 to 24 months, things, there a clearer picture could emerge in terms of how stocks, which sectors could do well from here on as well. This is another table that we have here. Again, shows the same thing. Market peak in FF21, but stocks continue to rise. And this is from just February 21 peak, which is just after the budget. The orange ones are the cyclical ones that have done well. Actually, you can include ONGC in that as well. It's a play on oil, and Asian Paints have done well. But apart from that, everything else is metals or ports or any other names as well over the last over the peak that the market went to 15,100 or so, or 200 in February 21, just 3 months back as well. And this is what I mean is that over the last sort of 16 years, these real economy stocks, metals, cement, capital goods, all these automobiles, oil and gas, these heavy real economy businesses, industries, used to form a really high portion of the weight of the index 16 years back. If you look at PSU banks at 5.8% here, right here. If you look at private banks, 4.7% in December 2004, cement at 2.8, metals at 8.2% weightage in the index, oil and gas at 27.1%. These were really large weights. And as we went to December 2008, and as we passed the next 12 years, things changed in the market. And, and over the last 7 to 8 or 9 years in India, a certain breed of stocks have continued to do well, and perhaps rightly so, considering the low interest rate regime that is there globally, the expansion of PE in stocks, the fall of the...
Mitul, your screen has frozen. Can you just switch off your video and try once again? Maybe it fixes it.
Yeah. Basically what we are trying to show is that the market is shifting in terms of the weight as well. A lot of these stocks that that have done well were significantly under-owned over the for many years, and because of the strong earnings growth expected out of these with improved ROEs, etc. Obviously these are cyclical stocks. They will not continue to do well over a 5-10 year horizon, but there are a significant amount of opportunities that are there in the market. Which because of the macro, because of a lot of other things, because what the management is trying to do, can turn themselves around, which are trading at still significantly decent valuations and have an opportunity to sort of turn themselves around and give good returns from here on as well. Here we just want to talk about SCDV framework, where secular companies are companies where out of the 7 out of the last 10 years have given profit growth of 15% and ROE of 15%. This is a proprietary investment framework at IIFL. Generally, in our mainline funds such as multi-cap PMS and focused MF, we are generally overweight the secular names, and balance the names are between cyclicals and defensives, generally in terms of our allocation. And we try to have significant underweights in value traps. The rally that we are seeing currently right now is significantly in the C and the V category, where capital goods, cement, metals, logistics, infrastructure, private corporate banks, oil and gas downstream companies are doing significantly better, and even certain value trap names are doing much better. So therefore we have launched, so therefore what we want to talk about here is, when you look at SCDV performance backtesting over the last 10 to 14 years, what we are trying to show you that over the really long term, 10 years, 14 years, the average CAGR of secular companies has been 13%, and they win win a lot. The green cells that you see here are the best performance in that year by that category. And if you see, green dominates it significantly, and the value traps are significantly in the red. But what we also need to appreciate is that there are certain years when cyclicals do quite well. So cyclical, if you look at 15, 16, 17, etc., cyclical stocks were one of the best performing categories. And perhaps we are in this sort of a cycle as well over the next 2 years, where cyclical companies and cyclical stocks and sectors will outperform, materially over the next 2 to 3 years. And as these companies sort of embark upon either deleveraging, significant cash flows, strong commodity cycles, strong rebound in demand over the next 2 years because of the COVID pandemic. So a lot of things are changing within these companies, and which are still available at attractive prices and can give good returns over the next 2-3 years as well. And here again, a back testing is that all these companies, whether you look at Infosys 15 years back was a secular company. Now it is a defensive company. Bharti Airtel was a defensive or a secular company 15 years back. Bharti Airtel, now it is a value trap. A lot of all these companies are not permanently secular companies for a long period of time. These companies shift quadrants. And when I mean by quadrants is that this quadrant here, Infosys was a secular company maybe 15 years back. Now it's a defensive company. Bharti Airtel perhaps was a defensive company. Now it's a value trap, which does not generate 15% growth and ROE. Lot of other names, right? Like HUL perhaps was a secular company many years back. Again, a defensive company. A lot of other infrastructure companies, between 2004 and 7 could have been secular companies growing much higher than much more than the economy with really strong ROEs. Now they have either become cyclical companies or value traps. So, companies move around these quadrants, either from the left to the right to the left, or top to the bottom to the top. So our point here is that, nothing is permanent, and markets dynamic shifts over a period of time. Companies change over a period of time. Growth rates change, the ROE changes, a lot of things happen. So here what we're trying to say is that when you started 10 years back, out of the 96 companies that were there secular, only 11% of the companies are still classified as secular 10 years later. So roughly 10 companies or 11 companies came out on top, and the rest either went to the defensive quadrant, cyclical, or value traps. 26% of the companies have been re-rated by migrating from value traps to other segments. When a company in our definition migrates from a value trap to any other quadrant, the amount of re-rating, the amount of stock price reaction is the most significant than in any other sort of quadrant migration. And that is also something that we are trying to capture in our new fund offering as well. Active management can help identify companies that might potentially drop out of high categories to re-rate into other high categories. So here is a really backdated example of 273 companies since 2010 that we have seen. And this actually keeps us feet on the ground in terms of not to extrapolate everything into eternity and think that a company that is growing currently very fast will keep on continuing growing fast for a long period of time. So that is one thing. And this is basically our IIFL Phoenix portfolio, where traditionally our main IIFL PMS, which is the IIFL Multi-Cap PMS, is overweight the secular quadrant, a little bit lower on the cyclical, much higher on the defensives, and value traps is significantly lower weight. In Phoenix, when you look at it, is almost the other way around. The defense secular businesses are at only 22%, cyclicals are 27% compared to 17%, defensives are 23%, and value traps are much more. It's almost 2x that of multi-cap PMS. And the large cap weight, mid cap weight, small cap weightage is sort of similar right now, because the kind of opportunities that we are seeing in IIFL Phoenix is something that much more in the large cap category. And here, in terms of the sector classification as well, financials is sort of similar, because that we, as I talked about, we are very positive on the financial sector. Industrials, is significantly more than 2 times the weight on the industrial side compared to multi-cap PMS. We are much more in communication services at 7% compared to 4.3%. Energy at 5.4 compared to 3.2 as well. Very low on consumer staples in both of these categories. Lower on healthcare since it's a defensive name. as well. Materials is lower. So, the much more cyclical sectors are there in this portfolio compared to a multi-cap PMS. And that's where we see the opportunities as well. Here we have a few case studies such as Srf Limited, again, a very well-known secular name currently, but it was a defensive name back in the day with low ROEs, with capital allocation issues, etc. But over the next 6 years, solid earnings growth has taken place. ROEs have gone from 8.2% to 22.5%. Stock price has gone up significantly. It has re-rated from 1 times price to book to 3.2 times price to book. What we are trying to show this graph is not to show you that we, not to show a graph which was really flat and then keeps on going up. What we want to show you is that if we had identified the turnaround event in SRF was always run by a very high quality promoter. From 2010 to 2014, its largest business was the technical textiles business and the packaging films business, which were cyclical in nature. They used cash flows, from these businesses and invested in the specialty chemicals business. And, where you see this green circle is the time that you started investing. But for 3 years or roughly 2.5 years, you wouldn't have seen any return in this stock because, they were investing in that business. But as that business started to perform, over a period of time, they invested 1,400 crores, which was a significant portion of their balance sheet then into the specialty chemicals business. And this business started performing, and the earnings growth that you saw over the next 6 years was remarkable. The stock price appreciated 50% CAGR. Earnings growth was 58% CAGR as well. And also what we want to show is that we don't want to buy businesses that are here and then sell them here. If we are confident in the turnaround of the business, in the stickiness of the turnaround, stickiness of the growth, and the ROE change that the business is seeing, there are much more better rewards to be had over a period of time. And we have a similar example here in case of IPCA as well, a similar graph here. And these are the companies that we have owned in the past or do own currently as well. So I have the ability to identify these names. We have currently in the IIFL Phoenix PMS a basket of 26 stocks, and we have a short list of 60 stocks in the portfolio currently, which we feel that are right, which have the right characteristics, either in terms of management change, shifting quadrants, shifting of ROEs from a single-digit ROE to a double-digit ROE. So a lot of factors that go into play in there. Here, our current valuation, as I mentioned, is 3.3 times price to book. Market generally, on a trailing price to book basis, spends 32% of its time between 3 and 4 times price to book. And since we are at the bottom half of this range, of the 3 to 4 range, there is still room to grow with expanding ROEs and earnings growth as we move forward from here. And here, this is the most important graph actually for any investor, is that the relation between time, volatility, and returns. Is that, at any point in time you enter the market, whether you come in at 10,000 Nifty, 7,000 Nifty, 14,000 Nifty, 15,000 Nifty, you have to give time. And this is actually really factual data. And this data goes back till 1990 actually, if that's correct. Yes. And so it's a really long time horizon. Is that the more time you give in the market, the volatility that you will experience in the portfolio will reduce. And as you enter the 5-year range, your returns will surpass significantly the volatility that you experience. And that is regardless of the time that you enter the market. So timing will not get you anywhere, but time in the market will help you, ensure that your returns are much better and you experience less volatility as we move forward. And that's all I have for the presentation, but I'm happy to answer the questions if whatever people have.
Right. So we will probably try to take a few questions now, and there are quite a lot of them. Okay, so one question I had asked before we changed the room was what is the kind of banks that will do well from here? Okay, and we had given options between HDFC Bank / Kotak Bank and the other the dominance of the Indian banking is SBI, ICICI, and Axis. Okay, so a lot of people chose that they feel the likes of ICICI, SBI will do better in the coming days. Do you want to take an opinion here, since you are talking about cycles, things you're talking about under-participated stocks? So what's your view?
Our view is, we are very clear. It's the largest position as well across our entire asset management firm. We feel that we're looking at the current price, how the business has shaped out over the last 4 years under their new leadership, how the next 3 to 5 years will be. From a short-term, medium-term, long-term perspective, we feel that ICICI Bank will do significantly better. It is actually shown, in terms of their metrics as well, becoming very close to the best in class. Obviously, history of ICICI Bank, keeps you under check all the time. But with the new leadership that the bank has, it is actually a very fast transforming bank. It's a much more leaner bank, much more profitable bank in terms of the ROAs that it generates, the NIMs it generates. The mix between retail and corporate has changed significantly. The CASA has gone up significantly. The share that they're taking in traditional kind of businesses, traditional side of loans as well, is also much, much better. So we feel that ICICI Bank can re-rate from here. It can experience much faster growth than it was experiencing over the last few years. And under the new leadership, I think it will go from strength to strength. So that's a very clear answer for us in terms of these banks.
Can we extrapolate that to Axis and SBI as well?
SBI, we own it actually in both of these PMSs. But SBI is a value trap in our definition. So it is not something that you get married to for a long period of time for us. We have bought it because we bought it, roughly 6-8 months back. It was if you adjust for its subsidiaries, it was trading at that point in time cheapest in its history. It went down to 0.3 times price to book, adjusted for the value of subsidiaries. Obviously, subsidiaries values have gone up much, much more. But there is a time to own SBI and there is a time to sell SBI. So it's not something that you can keep. But SBI also navigated the problem pretty well, in our opinion. So we feel that it should do well, in some time to come. But it's not something of a buy and hold like ICICI. Axis also should do well, in our opinion, under the new leadership.
So these are again not stock advices. So gentlemen and ladies, please exercise caution if you want to buy them. So the next question that I'm going to take is very interesting, and Mr. Vikas Katra asked this. So you've spoken about seculars becoming value traps or defensives becoming value traps. Have you ever can you cite an example where a value trap moves the other way in the ladder, becomes a defensive and then a secular, something like that has happened, or can it happen?
Yes. Many stocks, and these have been darlings of the market, not currently, but I can tell you that Eicher Motors was a value trap, which was a 100-bagger. Hero Motocorp in the 90s was a value trap. IndusInd Bank was a value trap before Mr. Supti came through. I'm not sure, but maybe Britannia was a cyclical before the new management came in many years back, 7-8 years back. I think before Mr. Berry came through. It is across sectors. Sun Pharma was a secular stock which became a defensive stock and perhaps might become may go down a little bit more as well. There are many names like this. I can also talk to you about the stocks which might migrate currently in our view from a value trap or a cyclical to a defensive maybe. These expectations over the next 3 years is perhaps it's a Bharti Airtel, perhaps it's a M&M, and if the plans that the management has over the next 3 years, if they plan a pan out, if they execute successfully, there's a definite chance of Mahindra and Mahindra becoming a defensive company as well. And there is a nice trivia for you guys, is if you look at 2018, if you just had stopped the clock at 2018, and of all the stocks that have been in the Nifty since 2004, okay, I think since 2004, so the stocks have to be there in 2004 as well. M&M had given the best performance in terms of stock price returns. But in 2 years, because of the mistakes that the management perhaps made, capital allocation related issues, whatnot, the stock price actually collapsed from 900, 950 to 250, 300 during the pandemic.
Right.
So it went from being a very strong compounder actually from 2004 to 2018, a 14-year period, but actually lost way over 2 years. And perhaps with this new management in place and with the actions they're doing, it can do much better over the next 3 to 4 years.
So the message I'm getting here, Mitul, is that it's not like that. These are not very rigid, boundaries that are there. Companies keep moving across the quadrant into different kind of across the square into different kind of quadrants. Okay,
Yes.
so with that view in mind, I've just got a question, and this is quite an interesting one. So I've got it on my WhatsApp. So the question is that you have a put option on your multi-cap fund, okay, which is more of a where the allocation to seculars is quite, and secular and defenses are quite high. Okay, will you have something like this on this fund, on the Phoenix fund, which is more of a cyclical, kind of a portfolio, and the perceived risk would tend to be a little bit higher. So what's your take on that?
That's a very, very valid observation that, the nature of the names we own, that, we are calling it heavy on cyclicals, we are saying more overweight on value traps, etc. This portfolio will definitely be more volatile than a multi-cap PMS. It will have more beta. Obviously we own 26 names. Obviously, there are some businesses which will, not will be able to successfully, turn themselves around or move quadrants. There will be some mistakes as well. So there will be a little bit, more churn in this portfolio. There will be some level of related risk in this portfolio, but that doesn't mean that you buy options. I have said it very clearly that the multi-cap advantage PMS that we have, where we have put options, is an insurance. It's purely an insurance. The investor can, it's just purely, you want to make money out of the stocks. You don't want to make money out of the put option.
Right.
But I agree with the main point is that this portfolio will be more, it will be just high beta. Our beta in our other funds have been less than 1. This will be 1 or slightly more than 1. But here the beauty is, Sankalpo, is that, we are not trying to only buy metal names. We have one metal name in this portfolio.
Right.
We have 2 auto stocks. We have a cyclical IT company in this. We have a cyclical pharma company in this. We have a cyclical auto ancillary company in this, which was a secular company, is still a secular company. But its last 3 years have been, been a disaster. But it's still a secular company with last 3 years being a disaster. Next 3 years, the earnings are expected to triple. So, it's across just sector. It's not just we are skewed to the ones that have done well, which I've shown you in the presentation. It is across sectors, but it is the fact that we are expecting a significant turnaround in earnings because of the cyclical nature in the market and the economy.
Right. Okay, so that's a point very well taken. But what the question that arises from your answer is volatility. And I have a few questions on volatility that have been asked on the chat board also. So at IIFL, how do you look at volatility? What is your advice on volatility? And while you said that over a 5-year period, volatility wouldn't have been as significant as you would think it is. But in the meanwhile, 5 years is a long time. People have portfolios that they look at daily. So what is your advice on volatility? How to look at it? And is volatility the real risk that one should look at, or is volatility just masking something else?
No, it depends, what lens you're looking at the world with. And I can understand that over the last 12 months, 15 months, or maybe last 2 years, we have experienced a significant amount of volatility, right? And it can unnerve investors as well. But I think, trying to be true to myself. Obviously, lot of experienced fund managers, etc., do get worried by volatility. But you should honestly, if you genuinely are a long-term investor in the markets, volatility should be your friend. It's very, very easy to say these things and act, accordingly. But the fact is that, if you have a bunch of businesses that you own, and you have the ability to, put more money to work as volatility increases, there's nothing like it. But we are coming, we are coming out of this. The world is coming out of this problem, where a lot of googlies are going to come at you, and volatility is going to come. There will be some inflation related scare. There'll be some taper tantrum as we move, into June, July. Then there is something or the other will keep on happening. But the fact is that, do you see, there is a very, 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 very interesting example. If there is a business which it trades at a price to cash flow, or cash flows are very important, right? Earnings matter very less in the medium to long term. Cash flows are very important. If you think that the business is going to be around, and you can underwrite these kind of cash flows, 1-2 quarters of earnings miss, and that is a great lesson market has given you last 15 months. 2 quarters, that day the stock might fall 10%, 15%, 20% over that week if the earnings are miss or something like that. But a 40%, a very large pharma company reported earnings yesterday over the weekend. It was a miss of roughly 40% on consensus. Today the stock was actually down only -2%, because the next 2-3 years are going to be amazing. I'm not going to name the business, but it's just going to be this thing. So cash flows matter a lot over a longer period of time. Volatility in the markets will be there. There will be tantrums, but you have to train yourself to actually look through the noise, and try to kind of capture the opportunity that is given you. If you're unsure of the business that you own and volatility comes through, you will get nervous. You will get nervous. So, or if you bought a business for borrowed conviction. So those things happen. And that's why it's more exciting to be in this line of work as well.
Right. I absolutely second you. So the next question is going to be something, this is my question. So I was just looking at your portfolio now, and you've got a lot of industrials. Okay. And it has often been said that the problem or the issue with India's rise is that we are not as integrated as we should be in the global supply chain with respect to industrials or manufacturing. Okay, what is your view there? Is the China plus one strategy still around? That people were talking about last year, and we club that question with a couple of other sectors. Like, you can club it with other views on other sectors like sugar, chemicals, which people have always been wondering about and waiting for a uptick to come. So what's your view on those?
Yeah, I was reading an economist article, I think it was, that I think Vietnam has some 1/10 the population that we have. Its share of manufacturing, its share of exports in manufacturing is more than India. Okay.
Right.
With an economy size as being much lower. So, we have not done justice to ourselves, right? Over the last 10 years, 15 years, 20 years, we should have been much bigger. And we didn't need schemes like PLI and all those things to incentivize us to do things well. Or we actually shouldn't want China to fail so that we gain, right?
Right.
But, such is the way it is. But, over the last 2-3 years, there have been strong undercurrents, I would say. And actually over the last 12 to 15 months also, with this, it is there, PLI scheme is there right now. When that is across sectors. I think last week it came for the battery sector, it has come for the pharma API sector, it has come for circuit boards, lot of other things, chemicals, etc. And I think what the government is trying to fix through this is not share of industrial, it's just employment, right? We have a large unemployment. I think they don't want, say, I'm just giving you an example, like they don't want Cummins, for example, to do well. So, that sector to do well and come up with a PLI scheme. The thing for PLI scheme is obviously share of exports increase and these industries employ a significant amount of the population, right? So I think that is their main goal as well. And these schemes, obviously, and China came up much faster in the world also because of their own version of PLI schemes, right?
Right.
As well. So we are trying to use that blueprint. And during the last 12 to 15 months, significant corporate deleveraging has happened. Roughly 2 lakh crores of loans have been repaid by the corporates. And and that leaves a significant amount of room for people to now reinvest further. There have been schemes that are supported by the governments, by the government as well. So there is, and these are not small, like 100, 200 crore capexes, right? To qualify for this, to be eligible for this, you need to put up significant amount of capex. And all these things will kind of come through. Infrastructure is happening actually at a much better pace than when we are seeing. And as utilizations level rise, which has not happened for many years, and if this sort of macro plays through over the next 2 years, you will see the supply shortages are coming up. Just to give you guys an example, the semiconductor problem that has been going on in the world is because if you just look at the semiconductor demand pre-COVID, it was always a nice flat line, plus or minus 1%. It used to happen. It never happened at all. But because of this pandemic, it's such a huge demand of semiconductor industry. People are putting up capexes of $20 billion in these. One company is putting up capex of $20 billion in the semiconductor industry, right? So, not that it's happening in India, but what I'm trying to say is that a lot of these opportunities are arising out of this, and companies will use this to put up capacity. We are seeing a significant sort of an announcement from a lot of companies which had not been announcing capex as well, right? Steel stocks, for example, had never announced a capex. 2 companies have announced a capex because now they're significantly deleveraged with superb cash flows, and they're going to put up capex which will come up in steam in 3 to 4 years' time. The kind of capex chemicals industry has done over the last 5 years is equal to the entire growth block that was there in 2015, for example. Then there are these API schemes, etc., that people are going through as well. So, these kind of things will come through as well. A lot of new technology capex will come through, like, say, for example, a Cummins, right? They are the #1 leader in data centers. As these sort of policies come through where your data centers have to be local, for example, pick up in CVs. These kind of things kind of give fillip to a lot of demand, a lot of pricing power comes through in sectors which have been dead for many years. But these are not secular sort of themes to play. These are pockets of opportunities that come.
Right. So you feel the same can be said about, because it's a specific question, can be said about the sugar industry per se, because we've been hearing a lot about ethanol, adding to their, revenue stream and been doing well. And overall, the cyclicity of the business has somewhat been mitigated.
Yeah, actually, Sankalpo, I'm a jack of many sectors, but actually, sugar sector is something. That I don't particularly understand too well. But I have read some stuff, but I think apart from that, I don't think I'll be able to give a smart answer on that sugar question of yours.
Right. So Ritika has asked about what companies, what are the 4 segments of SCDV. Don't spend too much time on that because you've done quite a lot of videos on that. Ritika, I'll request you to go take a look at them. So before we end today, so I'm going to talk about non-lending financials for a while, because that's something that we don't hear a lot. Maybe asset management, maybe insurance, maybe wealth management, maybe brokers have been have had they have friends in broking who say that this has been one of the best year. So non-lending financials, what is your view, and do you think that it can be one of those pockets of opportunities? And with that question, we'll probably wrap this up today.
Yeah, we are very much interested in a multi-cap PMS. We own one broker as well. We ourselves are in a way a non-lending financial part of the ecosystem. And we classify insurance also in this. When you look at general insurance or you look at life insurance, really, similar sort of themes are playing out here, that are playing out in the banks. Large market share with a very large on the insurance side, like I said, an LIC or an Oriental Insurance on the general side, etc. And there are 4-5 really large players on the private side relatively, which are taking share. Much very profitable business, good underwriting skills, very large opportunity, can keep growing for a long period of time. So we are very positive on that. We are positive on the broking segment as well. Though, in terms of, a lot of people talk about brokers, being very close to, the newspaper industry as a profitability is shrinking, etc., etc.
Right.
A lot of likes of, these digital platforms which are private equity funded, giving brokerage at very low rates, etc. But the opportunity is immense. So there is the pie is growing, but there is a significant amount of leeway in terms of growth there as well. So it's an interesting space, non-lending financials, in our view, whether it's on the broking side or the insurance side, as well, AMC side as well. From that perspective, it's pretty interesting when you look at these companies.
Right. So before we conclude, can you just give us like a concluding note on the Phoenix portfolio that you're coming up with? We've discussed a lot. You can set the tone, the expectation, the kind of time horizon that a typical investor should look at this for, and then we can wrap it up. Yeah.
So guys, just last point here on Phoenix is, we have a collection of businesses in this portfolio, and we have not tried to actually go down the quality curve here. When you look at the names that are there in this portfolio, these are top-notch business houses or top-notch managements going through a temporary issue or a speed breaker in their business over the last 2-3 years or 4 years, or the cycle has been bad for them. The business is good, but the cycle has been bad, and you have, there are sort of stages in terms of that SRF graph also I gave you. Is that company management comes up with a plan. It takes time for sometimes a plan is achieved, or its execution is done in 1 year. Takes sometimes 2 years, 3 years. But we have a collection of these businesses which are across the spectrum. Okay, some people are at its infancy of this turnaround. Some people are in the middle. Some people are at somewhere in the towards the other end of the spectrum. But still, the valuations, the market is not willing to believe the turnaround. So we have this collection of businesses across this spectrum where businesses are trading at a cheaper discount relative to its history, expanding ROEs or significant growth coming through over the next 2-3 years, and either reversion to mean will happen in terms of valuation or it will surpass its mean. So those are the businesses we are trying to own. We are not trying to own crooked managements here, or trying to play trading bets. As well, we think that there is a fair value to these businesses which are trading at much below their fair value, and we are trying to play earnings growth and a valuation catch up in these businesses. So some certain businesses we'll hold on for much longer. Certain businesses we'll sell once the catalyst is done.
I wish Shashi was here to answer this question. Phoenix is an interesting name. So what's the story behind naming it Phoenix?
I mean, just as the phrase goes, rising from the ashes. Very, very, very simple. We try to come up with a lot of names like turnaround, this, that, and all. But Phoenix is a name that actually really well suited. If you look at the businesses we own, I think this name will resonate quite well. With the name of the fund. Right.
Thank you to everybody for joining us today. Thank you, Mitul. I hope all of you are safe, not just from the COVID concerns, also because of the cyclones that hit the western part of the country. We will see you all very soon. Thank you, Mitul, for being with us, and see you soon to the audience. Thank you for being patient throughout the evening. Thank you.
Thank you very much, guys. Thank you.